I want to talk a little bit about the art of the deal today too, because a lot of folks, when we talk about investing in real estate, especially when you're building wealth and you're investing in real estate, you make just as much money on the buy. Matter of fact, the buy is probably as important, if not more important, than what happens in between and then the sale.
Well, I think it's the most important. And part of it is you're setting the stage. So whatever you're buying that property for is setting the stage for whatever success you're going to have after, right? One of the things that is important to sort of understand in the beginning when you're working with a client or with an investor is, what are you trying to accomplish? And specifically, if what they're trying to accomplish is to make their investment money, their investment capital grow and do it the right way, you have to buy it right.
My name is Rodman Schley. As a real estate expert, I've invested millions of dollars in vacation properties all around the world, and I've been involved in the valuation of billions of dollars of properties. I want to share my 35 years of experience along with vacation home investment tips from the top minds in the short-term vacation rental industry. Now, let's do the work. Hey everybody, welcome to the Vacation Property Secrets Podcast. I'm your host, Rodman Schley, and today we are lucky to have a big name in the real estate podcast space. Mike Litton is the host of the Mike Litton Experience podcast with over 266 episodes and over 2 million listens in 58 countries. Mike has over 33 years of experience in real estate, finance, and investing, and is passionate about being a father, a teacher, a realtor, and even more importantly, a leader. Mike, welcome to the show.
Thanks, buddy. Great to be here.
Now, it's so good to have you here. I was able to go on your show, had such a great time talking a little bit about my background, what we do in real estate investing. I thought, man, I need to have Mike come on to my show. So here we are today. We're going to talk a little bit of real estate. We're going to talk a little bit about deal making. We're going to talk about building wealth through real estate. We're going to talk about tax advantages with real estate. There's just so many cool things that we're going to talk about today that's going to be very beneficial for my short-term vacation investors.
That's awesome, man. That's my favorite subject.
I know. So you've been a real estate guy for how long, Mike?
Next month, it'll be 33 years.
33 years. So you must have started really young.
I did. I got started because I got turned down for a home loan. First one I ever applied for.
Into it?
Yeah. Be careful saying no to me, right? So I go and apply to somebody who is a loan officer that was referred to me and a company that was referred to me. And I get no communication, nothing. 3 weeks later, I get a form letter in the mail that says I've been denied. And so I go into the branch and I ask for the loan officer. He hides in the back, won't come out, won't talk to me. I'm a big guy and I'm a little intense, but I wasn't going to hurt him. I just wanted to turn a no into a yes, and he wouldn't help me. So I ended up going to talk to my dad. When life doesn't make sense, I talked to my dad and he said, I don't know why we're having this conversation. Okay. He goes, you've never taken no for an answer in your life. I raised you, remember? Right. And he mentioned a couple of different situations, right? And so I went and got my real estate license and got into the business on the mortgage side first, but then ended up owning a Keller Williams franchise for 18 years. And yeah, it's been a ride, man.
Yeah, for sure. I want to talk a little bit about the art of the deal today too, because, a lot of folks, when we talk about investing in real estate, especially when you're building wealth and you're investing in real estate, you make just as much money on the buy. Matter of fact, the buy is probably as important, if not more important, than what happens in between and then the sale. Why is that?
Well, I think it's the most important. And part of it is you're setting the stage. So whatever you're buying that property for is setting the stage for whatever success you're going to have after, right? And so one of the things that we do when we work with investors is we talk to them about the idea of not falling in love with a property. And, one of the things that is important to sort of understand in the beginning when you're working with a client or with an investor is, what are you trying to accomplish? And specifically, if what they're trying to accomplish is to make their investment money, their investment capital grow and do it the right way, you have to buy it right. In order to do that, you have to be willing to walk away from a deal or 2 or 6, right? You have to be willing to have a particular framework in terms of what works for you. We call it your buy box, right? What works for you? If it doesn't work, I don't care how much that property reminds you of the first house you lived, whatever, right? It doesn't, right? You have to get to a place to where you agree that if it doesn't fit your buy box, you walk, right? And by the way, if you walk, sometimes that's one of the best things you can do in negotiation because it comes back around, you know?
Well, and it's
incredibly important.
Just buying on fundamentals. I see so many people, especially in the short-term vacation rental market, where people aren't doing the analysis. They're not doing the fundamentals. They're not looking at the numbers. They go to a market, they fall in love with a house, or they fall in love with a market. They're like, man, I love to ski here, or man, I love to play golf here, or whatever it might be. And then they fall in love with this property, but they don't do the numbers to go, okay, they go, well, I'm just going to rent it out and it'll pay for itself.
Right.
Okay, well, how and how much and why and what should you pay? And so they don't set any thresholds. They don't set any boundaries. They don't set any barriers. And then all of a sudden you're looking at deals that you don't know if they fundamentally work or don't work. You fall in love with something and you know what happens after that. You end up losing.
Well, and that's it. You know, when you're buying a property, there's a seller, and that seller is trying to get as much as they possibly can for that property, right? As an investor, you're trying to pay as little as you possibly can going in, because the better you do going in, the more you set that stage for success and the more you protect yourself from downside. And I know this isn't something that people talk about very much, but it's incredibly important to talk about. Economies ebb and flow. Markets ebb and flow. They shift all the time. Okay, they're constantly shifting. Markets shifting today, right? And a lot of it has to do with interest rates, but a lot of it also has to do with where we are in terms of our economy and where people are in terms of their ability to create disposable income. That extra income that they have is what they're using to buy a vacation home. Okay. And if they get in there and they fall in love with that property, that seller is going to take maximum advantage, right? And we're just going to rent it out. We're going to rent. What happens when things go sideways? What happens when people stop renting vacation homes? What happens when things get soft? Years ago, a very good friend of mine, in fact, the best man at my wedding, was actually building an apartment complex in San Diego. And he called me up and he goes, hey, I just met a guy that when you grow up, I want you to be just like him. Okay. And he said, and I was, okay. He goes, he's 79 years old. He's standing out here on the site with me. And I said to him, we're going to get this thing going. I need to know who's doing your financing, who's doing your draws, right? Your financing structure. And he goes, who do I call for draws? And he goes, well, we don't have that. You call my assistant. Here's my card. You call my assistant. This is her name. You tell her how much you need and she wires it to you. And he goes, okay, so from your construction mortgage, for your construction financing account? He goes, no. They call it a facility, right? He goes, no. You don't have a facilitator? You don't have right? No. It's literally coming from my account. So you're building 7 other projects like this, and it's a 300-unit apartment complex. You're building 7 other projects like this around the country right now, and you're doing it all out of your pocket? He said, yeah. He said, it works better for me because I'm going to be across the street from another 300-unit project. They're going to be my competition. They may be mortgaged to the hilt, but when the economy goes the other way and we have to cut rent so that we're 100%, zero vacancy, 100% occupied, he said, I have the advantage. I don't have a banker breathing down my neck. I don't have a note I have to pay. I don't have interest I have to pay. I don't have, costs I have to pay. Nothing. It's coming straight out of my pocket. So I can afford to take a loss. I can beat that guy to death, right?
Yeah.
This guy knows because he's been around for 79 years, right? And he had been in the real estate game for 50 plus. He understands that there are times when, like in 2008, when the Great Recession hit, right? The dot-com bubble that happened in 2000, all these things that happened. By the way, Were you in business during 9/11? Nobody bought a single house for 6 months. Nobody went out and rented property. A bunch of the vacation rentals got canceled because people were scared.
Yeah.
Right? Now, eventually it came back, but it took time. You buy right, you literally take out an insurance policy on those types of tough times. Okay? And it makes it much, much easier for you to survive and to accomplish what it is that you're looking to accomplish.
Yeah. And then to not look at the fundamentals. I mean, again, if you're going to go and get a mortgage on a house and you don't understand what the income fundamentals are going to be, or you don't have a projected cash flow, number one, like you said, real estate cycles. It's just constantly cycling. It generally comes back up, but it might cycle down, but then it'll come back up. Historically, it's always performed very well over the long term, but you don't want to get caught up in those cycles. And if you look at like 2021, when we had the COVID epidemic, and I've talked a lot about this on the podcast, people were getting out of their homes. They were stuck. They started traveling because they could. Their kids were on a computer doing school. They were on a computer doing their work. And I did this. I literally got up, went to Manhattan Beach, California for a month and worked during the day and sat on the beach, at 3-4 o'clock in the afternoon, just to kind of break it up, to be out and about.
Yeah.
And what happened was there was so much volume in those rentals that people said, well, this is easy money. But they didn't look at the fundamentals, and they didn't think about what happens when things go back and they stabilize. And now everybody's like, well, that market is crashing, but the market's not crashing. It's just adjusting to normal levels from what was happening during COVID. So it's cycling back to a normal level. But the people who didn't buy on fundamentals, who just thought they were going to take the cash to the bank and it was going to be easy and they didn't have to think it through, are now going, oh my gosh, I'm negative cash flowing because I took out this mortgage and this is coming out of my pocket.
Right. And when you don't expect it, it hurts even more. Right? If you're not prepared for it, it hurts even more. And the thing that I always do with my clients is I ask them, so let me ask you a question. What was COVID like for you? We were in a shutdown in California for 60 days. What was that? You were out here. What was that like? What was that like for you? They shut down both of my gyms, right? And I had to get outside. I had to get my blood pumping. I walked 136 miles in 30 days.
We probably crossed each other because I was doing
half of it was up a giant hill in Carlsbad, right? But it was one of those things where I had to get outside. Like you said, out on the beach, right? I had to get outside. I had to go get my blood flowing and get out there. And people need to try to remember. I mean, a lot of people have blocked it out, but they need to try to remember they were climbing the walls during COVID. A lot of the traveling that happened, people were traveling because they were trying to stay sane. Literally, they were trying to stay sane. And because they felt like a caged animal, they were getting out and traveling just to go find some sanity, because they could, and they didn't know what was coming. They didn't know what was coming down the pike. So I try to remind people or ask them, what was it like? Okay, imagine something like that happens again. Hopefully it's a once in a lifetime thing. Those types of things happen. Look at the wildfires in Los Angeles that just happened. Right?
Yeah.
Those are all things that are outside of your ability to control them. What can you control? You can control how you buy that property. You can control, like you said, the fundamentals. You can control, okay, I've fallen in love with this property. Is it conforming? Does it meet what the zoning laws are? Is there future development that's coming that's going to affect this? Is there a freeway coming through here? Is there a state route coming through here? What are the things that are going to happen that are going to affect this particular property? It might have $1 million view, but if you have a freeway running in front of it, the view all of a sudden isn't $1 million view anymore. Right?
Yeah.
Those are all fundamentals. Those are all things that they need to lean on you for in order to be able to figure out, is this a sound investment?
Yeah. The other thing I tell people is reserves. It's good to have these reserves in place, because if things do cycle downward and you're not set up in a financial position to adjust, it's like the guy who had the apartment complex across the street. If that guy all of a sudden is struggling because he's got a note that he's got to be paying and he doesn't have reserves in place, because more competition comes in or because there's an event and you don't have the reserves, that is what puts you in a bad position. You don't want to have to put yourself into a position where you might be forced to sell or you have to liquidate because, things have changed.
Right.
You need to be able to ride out a storm, because in real estate with the cycles, there's going to be a few storms. Long-term, you're going to be fine if you can ride those storms. But I always tell people, put some reserves in place. And I don't know what people feel comfortable with. I put 6 months in place before I take a dime out of a distribution with our private equity fund. Before we distribute, we want to have a healthy reserve in place. And we don't even have financing in place.
Yeah. Well, it's one of those things where you have to have your own comfort level, right? But ultimately, when you're talking about vacation homes are, and I hate to say it this way, but vacation homes are a luxury. Okay. The very first thing that goes when times get hard are things like vacations. It's really hard. I mean, it's not what people want to hear, right? They want to think, oh, that house in the mountains that I fall in love with the $1 million view. And, all you hear is the wind and birds, and it's my escape. And I'm only going to be there 2 weeks a year, and then I'm going to rent it out the rest of the time. Great. But if you don't buy it right, and you don't have your fundamentals figured out, and you don't have any money in reserves, if something happens that's completely beyond your control, like the economy shifts or the market shifts, we're in cyclical economies. We have an activist Fed. People forget about this. We have an activist Fed, right? And so one of the things that I'll do is ask people, so let me ask you a question. What do you think the Fed's going to do next year? What do you think they're going to do the year at, right?
Who knows? I don't know what they're going to do this year.
Right? It's like you're standing in a crap stable and you're going, come on, 7, right? It's just, it's nuts. So that's the thing that gets me going is think ahead. Don't think about what's in front of you right now here. Think about what has happened in the past and what potentially could happen in the future, and just be prepared for it. Some people, 6 months is going to be perfect. For some people, they need 12.
Yeah.
Okay. It just depends upon your particular tolerance for risk. And it also depends upon where you are with the rest of your life. How secure is your job? Are you getting ready to retire? Are you at a place where you're going to stop with a W-2 income and go into a 1099 income where you're consulting? What are you doing? Where are you headed, right? And then be prepared, work it backwards, and be prepared for what that's going to look like.
Yeah, there's definitely no one size fits all, especially when it comes to people's goals, where they're at in life. There's so many different things, but the fundamentals are always the same, but how those fundamentals fit into your life can change. And that's up to you and what your goals are. If you're, like you said, maybe you're at the end of your earning career and you're ready to retire, or maybe you want to buy a vacation home and you only want to rent it out a couple of weeks a year, and then the rest of the time you want to be enjoying it. You got to look at all those different reasons and those goals that are personal to you. And then once you have those identified, you can make smart investment decisions based on your goals and your risk tolerance.
Well, the key to it is the smart part, right?
Yeah.
Because if you fall in love with a property, or you fall in love with a idea of what that vacation home is gonna give you, because we do it. We're emotional creatures, right? We make decisions based on emotion, which is not a rational thing. We make decisions based on emotion, and then we use logic to try to justify it. Okay. So we get all emotional, we get all caught up in all, the grandbabies are gonna vacation here, and they're gonna play in that pool, and they're gonna play in that ocean, and all this kind of stuff. We get all sort of into this romantic thing, and then we forget that really it's an investment. Real estate's a big deal. Real estate is some of the asset you'll ever own, right? Now it's versatile. Yeah, you can rent it out, you can lease it out, you can borrow against it, you can do all kinds of things with it. Just go at it the right way and then work it backwards, right? This is what we want to have. We want to have every family vacation at the vacation house, right? So everything after that, everything in between, we want to rent it out. Well, we're not going to rent it out for premium money, because we're going to be spending holidays. That's the premium time.
Yep.
We're going to be spending holidays at the vacations, right? So when we figure out what the rent income is going to be, it's going to be during the non-peak times.
and you got to account for that.
Exactly. Right.
Yeah.
So you just work it backwards. And then if you do nothing else, just remember this: don't fall in love with the property, fall in love with the deal.
Hey, everybody. I hope you're enjoying this episode of the Vacation Property Seekers podcast. I want to let you know about one question that I get all the time, and that's, how do I forecast my cash flow and my profitability when investing in a vacation home? Now, if you've ever wondered that, or you know somebody who has, you're in the right place. We've created a free training called Financial Forecasting for Maximum Vacation Home Profitability. Now, in this training, we're going to guide you step by step on how to accurately project rental income, estimate your operating expenses, and calculate your returns so you can make informed investment decisions. You can access the free training at vacationpropertyexpertnetwork.com. So if you're ready to dive deeper into financial fundamentals and maximize your profitability, visit vacationpropertyexpertnetwork.com. Yeah. Well, I will say that I've probably walked away from 50 deals to every one that I've taken on, going through, and maybe I'm a little bit picky. There's a couple that I've passed that I said, man, I really would have liked to have had that one, but the fundamentals weren't there. And I will tell you that in all my years, I've been doing this since I was 18, about 37 years, and I have never ever lost on a deal. Like, I've never had a negative. I know. Give me all the wood I can knock on there for sure. But even the worst deal that I had, I remember there was a deal that was just horrible. Worst deal. It turned out everything was wrong. Everything from the water line to the street going out to the furnaces going out. It was one of those money pit deals. And I still walked away. And that's when I was buying and flipping. I still walked away 15,000 positive. And it was one of those things where you get out of the deal and you go, well, after everything that collapsed, but if I didn't negotiate that deal right on the front end to lessen my risk, then I might have been saying something different on this podcast today. I might be saying, yeah, that was the one deal that really got me, and I was down 10 instead of up 15.
Well, and that's it, right? You made sure that you made the fundamentals work for you, and you didn't fall in love with the property. You fell in love with the deal. And that's ultimately and that's why buying is so, that, how you buy it is so incredibly important. It's literally where you position yourself. And, there's a book that was written by a guy by the name of Chris Voss called Never Split the Difference. And I'm a big Chris Voss fan. I've probably listened to that book 10 times now on audiobooks, right? In fact, I'm listening to it now for the 11th time. And I always pick something up. And what's interesting is, we have sort of this running theme going with our podcast about the power of questions. And you and I talked about this before we started. And it was interesting to me that he talks about he was an FBI hostage negotiator. He was the lead FBI hostage negotiator. So if any American was ever kidnapped anywhere in the world, he was the one that got the call at 3 a.m. And his job was to negotiate them safely out of the kidnapper's custody. And if he failed, people died.
Yeah.
Right? This is a guy that is telling the history of the FBI. And what's interesting is the FBI talked at people. As soon as they figured it out, of course, they got burned a few times and embarrassed, and they were literally excoriated by Congress. They figured it out. They started asking questions. As soon as they started asking questions, they started figuring out that they were more successful. Instead of assuming a lot of things, they stayed in curiosity and stayed out of judgment, right? Number one thing you need to do when you're buying an investment property is just be curious. Don't prejudge a question. Don't say, oh, well, that'd be a stupid question. I'd never ask that. Nope. There are no stupid questions. Ask. You know this. The more you get your Sherlock Holmes hat and your magnifying glass out in your pipe, right, the better you do in terms of discovering what's going on with the property. Okay. And a lot of times we go into this with this sort of view like this, and that's not what we should. Literally be taking the blinders away, and we should be looking at everything.
Well, I agree 100%. And unfortunately, when it comes to, it might be a little bit different with the seasoned investor who's done a lot of this, but vacation homes, a lot of times it's that one-off investor that's like, this is my first investment, or we just want a second home. And so they don't have those fundamentals down. And a lot of people, even in 2021 during COVID, are really suffering right now because they overpaid, thinking that the fundamentals that were happening at that time were going to carry on after COVID. So they bought up here, they bought based on emotion, they bought based on a lot of things. And now they're wondering again, they're struggling. And like you said, it's a luxury item. It's one of the first things to go. So if you start struggling or suffering, what are you going to do? Well, we're going to liquidate the vacation home.
Right.
Unless you've reduced the risk and gotten smart and putting yourself in a position to weather a storm or to get back to normal.
Yeah. Well, it's kind of like what Warren Buffett always says, right? You want to be greedy when everybody else is being conservative. Okay. And you want to be conservative when everybody else is being greedy.
Yeah.
Okay. So somebody like a Warren Buffett, if you look at it the way he looks at it, he would have all the reserves in place. He would have everything ready so that he could weather that storm. So if he bought here and the market went here, he'd have enough in the way of reserves to where when it got back up here, he could potentially sell it if he wanted to. That's what you want to be looking at. And I think the smartest thing somebody can do, anybody that's looking to buy a vacation home, is to call you and ask you specifically. Let me ask you a question. If you were investing in this property, if this was a property you were buying as a second home or as a vacation home, what would you pay for this? Okay. Because you're looking at property every day. Like you said, you walked away from 50 of them, right?
Yeah.
You're looking at them every single day. You are dispassionate. Yes, there are things about property that you like. There are things about property that I like, right? I like properties that are on the beach, in Manhattan Beach in particular, right? Great place, great place. And, like heaven on earth kind of thing, right? But when you have somebody like you who can look at it from an investor standpoint and has been doing this since you were 18 years old, right? 37 years, you can back up and go, you know what? I don't think I'd pay a dime over this. And I guarantee you the people that ask you that question and you answer it that way, they're going to be shocked because they would have paid a lot more. In their mind, they already figured out they were going to pay a lot more.
Well, and then the reverse question of them is, well, great, what's going to be your NOI on this property? What's going to be the return on the purchase price?
Right.
And most of them will look at you like, what?
Exactly.
Like, what are you talking about? It's like, well, have you run your numbers? Have you looked at how much income? Have you looked at what the occupancy rates are going to be? Have you taken your expenses into consideration to get to that NOI? Right. And then look at your sales price. It baffles me. If you're going to invest in a property, it baffles me that you wouldn't know that, or you would not take that into consideration or look at that, because that's the most important thing for an investor. What's my return going to be on in this investment? And then if I've got one that's 4% over here, but I got one that's 11% over here, hey, let's focus in on the 11% one and see what kind of deal we can get done.
No, it's true. And here's the other thing. And this is something we deal with out here a lot in California. And you know this. People bought a house 15, 20 years ago. Okay. The house is now worth $1.5 million more than they paid for it. And they take that frame of reference and they assume that that's the way it's going to be in Golden, Colorado, or that's the way it's going to be in Boulder, or that's the way it's going to be at Vail, right? And it's not.
Yeah.
It's not the way it works. Now, there are places like Colorado and Idaho and some other places that have absolutely no use whatsoever for Californians. They'll tell you to your face. They've told me to my face, right? Because all these Californians come in with all these millions of dollars in equity and they run up the purchase price or the values of the other properties, right? And squeeze them out. Okay. The reason that happens though, is because they're flush with cash and they have this idea in their head, these Californians do, that property is going to continue to appreciate the way that it has in California. It doesn't happen that way.
No.
That's a dangerous way to think.
Yeah, I always tell people, even in their analysis, when they're looking at any kind of market, I always say, look at the 10-year historical data and see what that market has done in terms of appreciation. Now, I tell them to look at it and get an average idea of what it could appreciate over a 10-year period. But then I also tell them to go, okay, but there's no promises it's going to continue to do that, or it might cycle. There's these things that are going to happen. But sometimes, most of the time in 10 years, you can see the cycles. You'll see appreciation, maybe a little bit of a downward, and then back up again. But I always tell people, look at what the potential is for that upside. Then I always apply 3%. I'm like, I could be in a market that's saying 10% annual appreciation. It's been doing it for 10 years, and it's been phenomenal. And I will still do my pro formas when I'm looking at my investment, and I will plug in 3% and go, okay, I'm going to plug in 3. If we get 10, that is fantastic. But conservatively, I think we can get at least 3.
Well, I think it's important to think about it in context too, right? Because if you go back and look at what's happened in the last 15 years, okay, you have a great recession that took place. You have an activist Fed that knocked interest rates down to 0. Okay. You have an activist Fed that took on a almost $10 trillion balance sheet to drive fixed rates down. You have, everywhere you turn with regard to the Fed, for a very, very long time, right? 15 years or so, or 13 years or whatever it was, you had 30-year fixed rates that were in the 2s and the 3s. That's a big difference from where it is now.
Huge.
Okay. And so all of a sudden you have people that will not sell their houses now because they're stuck in a 2.625 interest rate. Okay. That affects inventory, that affects prices, that affects values, everything. Plus, you've got interest rates now that are in the 7s.
Yeah.
So if you're financing this thing, you got to put it in context. And then you have to ask yourself as a buyer, as an investor, what are they going to do tomorrow? Right? Now, Trump's been elected, and Trump was elected on this platform that he was going to lower interest rates. Okay? That he was going to lower inflation. He's lowering inflation, but he's doing it, or trying to do it, with energy prices. Energy prices are going to take some time. It's going to take time to drill, baby, drill.
Yeah.
Right? It's going to take time to get there. We cannot and should not assume that we're going back to interest rates like they were during COVID or during the Great Recession anytime soon.
Yeah. And it usually takes that recession to drive those down. They'll try to, try to stimulate the economy by bringing them down. But, with inflation, they're trying to hedge that, of course, by keeping them up. So I'm with you. I don't think we're going to get any big reductions. I will say, though, like when I started my private equity fund, which wasn't that long ago, when I came in and when I was doing my pro formas on our investments, I was conservatively plugging in a 6% interest rate. This is back when you were in the 2s, right? And I was being that stodgy investor who's like, I'm going to plug a 6% interest rate just to kind of reduce my risk or to kind of buffer anything that might go wrong. And then just like that, overnight, all of a sudden, interest rates are up over 7.
Yeah.
And I was thinking, wow, my conservative estimate that I was talking about just 2 weeks ago is now out the door. It's not even conservative anymore. Matter of fact, it's too low. Yeah. And that kind of thing can happen overnight. Should it scare you away from doing things? No. Oh. But should you understand the fundamentals behind it and the importance behind it? When you've got a 2.5 or a 3% interest rate, and you're trying to really increase your return to the cash that you have in a deal, a 3% interest rate's great. Yeah. But once it goes to 4, 5, 6, 7, all of a sudden it reduces to a point where you might not even benefit by getting an interest rate or getting a loan because the interest rates are too high.
Well, and the other thing to think about too is how does that affect, right? When interest rates go up like this, like they have, how does that affect the vacation market, right? Because all of a sudden you've got less disposable income. Your inflation's high. Like you said, interest rates are up because they're battling inflation. Okay, so you have to put those things into context. You were talking about stodgy, almost like it was a bad word, right? But stodgy equals smart.
Yeah.
Okay, that makes you a smart investor. It's okay to be stodgy, right? When you're holding on to your numbers and your fundamentals, because you have to. You almost have to white knuckle it a little bit, right? Because there are all these other things going on and all these other forces out there that are like, oh, just relax. Don't be so stodgy. Just relax. It'll be fine.
Yeah.
Right. And it's like, no, when you're looking at fundamentals and you're looking at something as big as real estate investment, you have to stick to your numbers. You've got to stick to your core, and you got to make sure that you take care of the downside and let the upside take care of itself, right? That's one of the things that Warren Buffett preaches all the time is you make sure you deal with the risk, and then the upside takes care of itself.
Yeah, it's funny. I don't usually use the word stodgy. I usually say that I'm a conservative bastard is what I say. And it's the truth. I mean, that's the thing about it is if you're going to be a really solid investor, be conservative. I will always underestimate my income. I'll always overestimate my expenses. I'll always make sure at the end of the day, I'm looking at that NOI, and then I'll come in with a cap rate. I'll say, no, if I would like to be at 10, I'll try to negotiate at 12 or 13, or,
Right.
You just got to really, if you understand the fundamentals, you'll know how to negotiate also to make sure that you're getting a deal it's going to turn out for you. And like you said, these are big deals. This isn't like going and buying $1,000 of Coca-Cola. This is buying a $500,000, $2 million home.
Yeah. And it's so unbelievably important to stick to your guns, stick to your numbers, stick to your fundamentals, right? Because all kinds of things, like we talked about, the Great Recession, the dot-com bubble, all these different things that could happen, COVID, right? Who in the world expected COVID?
Yeah.
And you listen to Trump, and Trump talks about how in his first administration, we had the best economy we've ever had in the history of the world. I don't know that that's the case, but right, according to him, it is, right? And then all of a sudden, here comes COVID. And, to an extent, he believes COVID cost him the presidency.
Mm-hmm.
It probably did.
He might be right.
It probably did.
Yeah.
Right? But here's the thing. We weren't prepared for it. We weren't ready for it. And all those people that had vacation homes that couldn't, because people stopped renting, right? People stopped going on vacation. The vacation rentals that ended up taking place were people relocating because they were climbing the walls.
Mm-hmm.
That's not a vacation rental. That's somebody seeking sanity, right?
Yeah.
It's a different dynamic. And so it's so unbelievably important that people emulate that being stodgy.
Yeah.
To use your, right? I don't want to use the other word, but you need to be conservative. You need to be almost like that grumpy old man that's just, you're not going to consider any other option except this. And once that's taken care of, let the rest of it take care of itself.
Yeah, we had a little bit of a down year last year with our Costa Rica property. And, there was a couple of elements. One of them being the Canadian dollar was weak. We get a lot of Canadian tourism down in Costa Rica, a lot of it. And so the Canadians weren't coming down like they were. And it had a really big impact on our cash flow. I mean, luckily we had no debt on property. We had, we could always scale back on the people that we had working there. We didn't have to scale them back too much. But at the end of the day, we were fine. We might not have quite got the returns we wanted last year, but we didn't suffer. We were never stressed because, now what are we going to do? There was never that because we understood the fundamentals. We understood what the income stream was. We understood what we needed to do if we need to scale some things back. It just baffles me why people don't take that time if they're going to make such a big investment to really understand the what ifs, or to be ready for if risk presents its ugly face. How do I look it in the eyes and beat it?
Yeah. Well, how do I prepare for it?
Mm-hmm.
That's the biggest thing, right? The biggest thing is to prepare for it and be ready. That's why you buy the right way. You buy the right way so that there is potentially an exit other than foreclosure, right? You buy the right way so that you have a return and the return is locked in.
Yeah. Yeah. Well, Mike, this has been great today. I want to make sure before we get out of here, I want to make sure that people know where to find you. What's the best place for them to come if they want to connect with you?
Hashtag the Mike Litton experience is probably the best way. We're really focused on doing that right now. It's our website's reo760.com. But the Mike Litton experience, if you just type in the Mike Litton experience in Google, you'll find us.
Yeah, no, that's great. And you can find the interview coming up with me on there. I don't know when that's coming out, but
be a little bit. We're still in editing.
It was so great to come on the show. So I would highly recommend that people go check you out there. The last question I like to ask, and I always ask this of all the guests, we got so many new people coming into the business, and we've been at this for 30 some odd years. I hate to tell people that because then they'll go, oh, geez, that guy's way older than I thought he was. But at the end of the day, you've got these people who are just coming in as investors. what would be your one piece of your best advice that you could give that new person coming into the business?
As an investor,
Yeah.
stick to your fundamentals. Stick to your fundamentals. Go pick the right person to represent you, especially somebody who's been doing it for 37 years like you, and listen to their advice. Ask them, right? It's one of the things that happens a lot is people come into buying a property and they think they've got it all figured out. They think right? And all they're doing when they hire a broker like you is they want you to dot the I's and cross the T's and keep them out of court. Well, your job is to do that too, but you're also there as an advisor. And you're somebody, like I said, who can back up dispassionately and go, you know what? I wouldn't do this. The best thing a client can do, especially somebody who's new, is lean on your expertise and your experience and literally ask you, if you were me, would you buy this place?
That's good advice. That is good advice. Matter of fact, the advice that I would probably give too, that'd be my number one piece. So Mike, thanks for coming on the show today. Really appreciate it. Make sure you guys reach out to Mike if you get a chance. Go check out his podcast, see what he's doing. Great person to be connected with. So Mike, thank you.
Appreciate you, bud. Thanks so much.
Thank you for tuning in to this episode of the Vacation Property Secrets Podcast. If you enjoyed the show, we'd really appreciate it if you could leave a rating and a review on Apple Podcasts or Spotify. By leaving a review, you not only support the show, but you also help others find and enjoy it just like you did. Also, please share this episode with somebody who could benefit from it. And if you're aiming to build a short-term vacation rental investment business that's based on strong investment fundamentals and not just emotion, I'd love to invite you to a free training that I'm hosting. It's my financial forecasting for maximum vacation home profitability training, an on-demand video course that's completely free. It walks you through the investment fundamentals to build and scale your short-term vacation rental business. You'll also learn how to estimate investment income and your operating expenses to build a projected pro forma operating statement and the potential NOI and return on investment for your property. Just go to vacationpropertyexpertnetwork.com to get access to your free training. We'll see you next week for another episode of the Vacation Property Secrets Podcast.